It's Tuesday, so it must be another brunch with Bobby. So welcome everybody. We're thrilled to have you with us again today. And today we're really excited to have a special guest in our series. As you know, Bobby Babis and I have been hosting these since the beginning of the work from home period. And today we have a special guest, Dr. Jeff Fisher, who many of you know from his work at IU and his textbook and having written the book on financial investment analysis for commercial real estate. And today he's going to take us into MarketEdge and help go through a couple of examples of how we do investment analysis and presentation with the MarketEdge solution. So thanks for joining us, Jeff. Thanks everyone for joining us from home. Hope you're all doing well and appreciate your taking advantage of the time and sharing the hour with us as we go through the program here. Jeff will take a deep dive into a couple of analyses and certainly be accessible for questions. So as you have questions along the way, post them, I'll queue them up and we'll take it from there. Bobby is also on the call since it's his brunch and he's hosting. So we'll make sure that if you have other questions, even beyond the analysis, we'll try to cover them as well. So you've got us all here ready to answer your questions and try to make the most of your time. So Jeff, take it away.
Okay, thank you, Jeff and Bobby. Keep this real informal today. Jeff mentioned my textbook. Actually, I'm working on a revision of that textbook, and I've had RealNex in the textbook for quite a few years, showing how you can get the same answer with RealNex as I go through in the book. And what I wanted to do is get a more realistic example. The example that I had in the book had a lot higher interest rates and returns than we can expect in the current market. So actually I was in the process of creating a new example, which is what I'm going to go through today. So kind of a textbook example, but hopefully somewhat representative of the kind of rates that we see in the market today. You can never get it exact, and of course it depends on the geographic area of the property and size of the property and a lot of other factors. But the example I'm going to show you is Monument Office. I called it Monument Office 17th edition because it'll be in the 17th edition of the book. The old one over here is the one from the 16th edition. So I think everybody probably listening in knows how to get into RealNex already and how to get into the different areas. I'm in the investment tools area. There's also lease tools and of course other areas that you've talked about in other webinars. So I'm in the investment tools area. I'm gonna pull up this property, Monument Office. It's a fictitious property, but again, hopefully somewhat representative of other office properties. In this case, I have an example of an office property. So have some general descriptive information. Some of it's more for your reports than it would be that it would affect the actual analysis. But there are some key things on this particular one. Let me see the best way to do this here. Okay, so we've got a purchase price of $12 million. It's an office property. It's got 96,000 rentable square feet. It's got a total of 100,000 square feet because of common areas and so forth. The rentable square feet is 96,000 on this property. I'm gonna, let's see, there we go. We've got information on the address and so forth, but of course that doesn't affect the calculations. The land value is $1,800,000. That's important for the tax calculations because only the building can be depreciated for tax purposes. So there's an input here for the amount of the land. This is to estimate the resale price, the capitalization rate used to estimate the value when we're going to sell the property at the end of the holding period is going to be 7.75%. And so that's divided into the net operating income the year after you're going to sell the property. The idea here, notice there's an option subsequent year. I could uncheck that, but what's typical is to use the net operating income 1 year after you're selling the property. That might sound a little odd at first, but the idea is that's the first year of income to the buyer. And so we're applying a capitalization rate, simple cap rate concept in order to estimate the resale price by saying, what would a buyer be willing to pay based on the net operating income that they're going to see when they buy the property from me at the end of the holding period that I'm going to have. So see, we got some resale expenses. I don't have any in this particular example, but I could put 2%, 3%, whatever I think would be appropriate resale expenses that would come out of the resale price on the property. There's a lot of descriptive information here at the bottom. I haven't filled it in for this particular example, but that's all useful for creating a report. Let me come back over here to the right, point out a couple more things. Here you see, and this is actually brand new as of about a week ago. We used to only have one input here for a discount rate, but there's actually 3 different discount rates that are important in analyzing a property. The overall discount rate is a rate of return that you would want before taking into consideration any leverage on the property. And so we're going to see how that can be used to estimate the value of the property by applying this discount rate to the unlevered cash flows that we have each year. There's also an equity discount rate that's going to be used to discount the cash flows after your financing. That would normally be higher than your overall discount rate because of the way leverage hopefully results in a higher rate of return on your property. Of course, leverage isn't necessarily always favorable, but when we buy a property or when we borrow money, we hope we're going to get a higher return by earning a higher return on the property than the cost of our debt. So hopefully we're able to borrow money at a lower rate than 8%, and that's going to leverage our return up. So we want to see if, in this case, we can get at least a 12% rate of return as an equity discount rate. The idea of a reinvestment rate is to say, what if I can't earn that 12% rate of return on cash flows that I have to reinvest every year? Some people, this is emphasized in, for example, in CCIM courses, that if you can't earn that higher rate of return on capital that you're reinvesting, you could make an explicit assumption about a reinvestment rate. Sometimes it's called a safe rate. So in this case, we're saying on cash flows that would be reinvested. If we want to calculate something called a modified rate of return, we could assume that we're going to reinvest the cash flows at a 5% rate. That was a lot just on that one screen, even though there was only a few key inputs. So let me pause there and Jeff or Bobby, and see if there's any questions on what I've talked about so far. Nope. Okay.
Nope, we're good.
Okay. All right. So let me go to the financials.
Although there's an appreciation for the reinvestment rate, so well done in getting that plugged in.
Oh, thank you. I appreciate that. Actually, go back to that. Yeah, it was kind of always bothering me that in the program it only had the one discount rate, because I wanted to be consistent with things that we talk about in CCIM courses, for example, that I have to revise several years ago, and so I was really happy that we were able to expand that into those 3 different rates. All right, going on to the financial tab. I was in the general tab up here at the top. So now I'm going to the financial tab. The key thing here is I'm putting in the loan information. You could have up to 3 loans. We're just gonna have one in this example. So we're gonna have equity. It says down payment here. Our equity investment in the property is $3,600,000. So we're going to borrow the rest at an amount of $8,400,000. And that's going to be a fixed rate mortgage. We could have an adjustable rate, but we're going to have a fixed rate mortgage, 20-year amortization. We're going to have the monthly compounding as would be normal, monthly payments, interest rate of 4.25%. I think that's kind of in the ballpark, maybe slightly high. It's always hard to come up with a rate that, when you're putting together a textbook that's going to last for for several years. So I think that's kind of in the ballpark, probably a little high of today's rates. And then if I hit the calculate button, that would, if I'd change anything here, that would recalculate it. But here we have then monthly payments of $52,015.70. We could also have some capital reserves, capital expenditures that we're going to put in that we want to borrow money on. I don't in this particular example, but that'd be something that we could add. And at the bottom here, oh, you notice you could have some closing costs and some points on the property if you wanted. Points being a percentage of the loan amount that comes out of what you're borrowing. The federal income tax rate here in this example, 35%. Put in whatever rate that you want here. This used to force you into specific rates from a tax rate schedule, but the way the tax laws are now, we thought it made more sense just to allow you to put in whatever rate you think would be appropriate, along with your capital gain tax rate. Maximum rate for somebody in a 35% tax rate category would be 15%. Although there's some recapture I'll talk about here in a little bit that would be at a higher rate for your depreciation. Passive activity rules has to do with what happens if there are losses on the property and whether you can carry those forward or not. And then if you want to add a state income tax rate that's added on top of your federal income tax rate, you could do that as well. The main thing here, I think, is the federal income tax rate, 35%, and your long-term capital gains tax rate of 15%. Okay, we move on to the income category. Now, I didn't really. I kind of jumped right into this example, but maybe to make it clear, what we're trying to do is take a property that maybe it's one that we're interested in buying. Could be something that's listed, and we have this additional information, and we have some information on what the existing tenants are in the property. And what we want to do is say, well, if we buy this property at that purchase price that I had mentioned back here in the general tab, if I buy it at the $12 million purchase price, what kind of return can I get on that investment? And if I borrow money, does that help me or not? Does that increase my rate of return above what it would be if I didn't borrow any money? And what kind of return would I get before tax, and what kind of return would I get after tax? And so these are all questions that I'm going to be able to answer. And then coupled with those discount rate inputs that we've talked about, we can also say, what should I pay for the property if I want an 8% rate of return before I borrow any money? So we're going to be able to answer a whole lot of questions based on our projection of the cash flows. In order to project those cash flows, of course, a key thing is what kind of rent we're going to get from our existing tenants. In this example, I have 3 different tenants. I'd originally had an example where I had more than 3, so you see ones I just didn't fill in the information on. I've got a bank, I've got a law firm, and a broker, so I'm just using these 3 in this particular case. So the bank has 70,000 square feet. Its base rent, before we have any recoveries or anything added onto that, is $14 per square foot. Notice I could put the inputs in other ways, like I could put month, I could put per year, per square foot per month, per square foot per year. So I'm using per square foot per year in this case. So I've got $14 per square foot per year. On the bank, it's 70,000 square feet. I've got a law firm, 10,000 square feet at 1450, and then I've got a broker, 16,000 square feet at a rent of $15. What I had in mind when I put this example together was that these leases were signed at different time periods. So the bank signed a lease when rents were $14 per square foot. The law firm signed one when rents were $14.50 a year later, and then 1 year later, the broker signed a lease at $15 a square foot. Each of those were 5-year leases, and so we're going to see that they expire at different time periods. The bank is expiring June 30th of 2023. The law firm doesn't expire till a year later, 6/30/2024, and then the broker is 6/30/2025. Then we'll see here in a minute that an important part of this type of analysis is, well, what happens when those leases expire? And so we're going to have some information about what market rents will be when each of these leases roll over. Could specify a start date. We don't really need to, because the important thing is that it's going to expire a certain time period from today, and this is what the rents are when we come into the lease at, at the start of our analysis. We could specify some vacancy associated with each particular lease. What I've actually done in this example is have a vacancy rate that kicks in. It's called a general vacancy rate that just kicks in because we don't know necessarily which one of these tenants might leave before the lease is up, or when the lease expires, how long it's going to take for that lease to be renewed. What I've assumed in this example, let me jump up to this. In the property tab here, you see it says refine global vacancy. So what I did is I assumed that starting in year 4, because that's when the first leases are rolling over, I'm going to have some vacancy. It's going to be 5% per year in year 4 and thereafter 5% per year. I'm assuming no vacancy the first 3 years because I've got leases the first 3 years. Of course, we could add some vacancy in, even though we have no leases expiring the first 3 years. Actually, a lot of lenders say, well, yeah, but we don't know if you're going to lose a tenant. Back in the current market, it would make a lot of sense to say, we could be losing some of those tenants. They're suddenly not paying their leases, and we're going to go ahead and put in some vacancy starting right away to take that into consideration. I'll cancel though and leave it the way it is. We could also indicate if there's some tenant improvements that we're going to have to pay to that tenant when the lease starts, and if there's commissions that we're going to be paying. So we have a lot of other options that we could enter in, but I'm just keeping this example pretty simple, just by having the base rent. But we do have to take into consideration what's going to happen when those leases come up for renewal. So you see we have a tab here that says reimbursements and renewals. Before I jump to that though, notice this I think was added just this year, the idea that you could import a rent roll that you may have in a spreadsheet, or export the rent roll. With 3 tenants, it's no big deal, but if you had 20, 30 tenants and you already had that information in a spreadsheet, you could import that right into the program without needing to re-enter everything. So let me go into the reimbursements and renewals. So you notice we can select each of the tenants here. So it started off with our bank, but I could pick if it's a law firm or the broker that I want to enter the information in for. And so we're saying when a lease renews, it's going to be, or when an existing lease ends, I should say, we're going to have a new lease that goes for 5 years. no rent abatement, but again, in the current market, maybe we need to start having some abatements. We may not be able to get a new tenant in there right away. Remember, I have a general vacancy rate of 5%, so I'm kind of accounting for some turnover vacancy by that general vacancy rate. But if I wanted to have some additional vacancy associated just with the bank, I could add that in here. I could also have some tenant improvements and leasing commissions. Again, I was trying to keep this example fairly simple as a textbook example, but typically you would have some tenant improvements associated with a lease rollover. When a new tenant comes in, you know, they want to have a certain amount of TIs, and of course you're going to have some leasing commissions associated with that. So you would enter those in here, and you would again be able to do that for each of the tenants. And then when that lease comes up for renewal, what's going to happen to the rent? Probably not going to stay the same. I think the bank was $14 a square foot. What we're saying is, well, when that lease comes up for renewal, it's going to jump up by $2.75. And it says every 5 years, with the idea that every 5 years we're going to bump it up another $2.75. But again, there's different ways that we could do that. Here it's based on per square foot per year, but I could look at a percentage of what the base rent was. So it's a percentage increase off of what I had before. And then I could also have the rent change during the lease term for those new leases. But in this case, I'm keeping it a flat rate until the end of the lease term. And then the reimbursements. Okay, this is a real important input. The reimbursements are the amount of expenses that the tenant is going to have to pay. And there's different ways, again, of entering in that reimbursement income. We could have no reimbursements, which would be like a gross lease. We could have, as I have in this case, which I think is fairly typical, a base stop amount. Okay, and my base stop amount is $280,000. So the idea there is the owner is going to pay the first $280,000 in expenses, and that would be what the expenses would be based on the square feet that they have. Anything above the $280,000 is going to be passed through to the tenant. That's the way your reimbursements work when you have a base stop amount, and that's going to apply to new leases as well. So when a new lease comes in, we're going to have a reimbursement based on an amount above the expenses that were in effect when the lease was signed. Okay, so we have that for each of the tenants, the bank, the law firm. It's going to be different amounts because remember they had different base rents. The law firm in this case is going to jump up by $3 per square foot when that lease comes up for renewal. And then when we go to the broker, oops, go to the broker, they're going to jump up also by $3 per square foot. But they're at a higher base rent to begin with, so actually their rent when the lease comes up for renewal is going to be a little bit higher. Okay, so we've talked about the income that we're going to have from each of the tenants and what's going to happen when those leases come up for renewal. Just a couple more inputs before we get to our output. We've got expenses, operating expenses on the property. At the top, we have the property management fee separate from the other expenses because that's typically not reimbursable, although we could check this box for reimbursable, but I believe that it's pretty typical that your property management fee is not something that would be part of the reimbursable expenses. Remember, we're gonna reimburse any expenses that go above a certain dollar amount, but the question is what expenses are eligible to be included in those expenses that we can get reimbursed from the tenant. So we're not going to have the property management fee reimbursable. don't have any replacement reserves on this property, but we could have some replacement reserves. I didn't talk about speed analysis. That's a way of saying I don't want to enter in all the details on all the expenses. I just want to indicate that in total, I'm going to have a certain dollar amount of expenses. It's going to increase by a certain percent. We had actually the same thing back on the income stream where we could do a speed analysis, but more fun to enter in the specific information. And so in this case, we've got property taxes, and there's default names. If you were starting with a new property, you would have default names here, but you can change any of those. If I click on it, I can change the titles. Okay, so I put in what I wanted to have in this example. Property taxes, it's going to increase by 2% per year. Going to be 148,800, increasing by 2% per year. Insurance, 14,400, increasing by 4% per year, so forth. You get the idea. I think the important thing is we can have different increases for each of these expenses, and a whole lot here that are available to you if you wanted to use them. These are all default names that are left that I wasn't using. So lots of possibilities for what you could put in for the expenses. You'll notice I've got the checkbox for reimbursable indicated for each of these. I could uncheck one of them if some of these were not reimbursable, then I could uncheck that. I think what's fairly typical anymore is that property taxes, well, all these are reimbursable, everything but your property management. And then if I had some additional capital expenditures, replacement of the roof, that sort of thing, I could put that down here at the bottom. Okay, so that's my expenses. What I've talked about so far is all the different inputs, and we can come back and revisit any of these based on questions that you have. But let's look at the projections because that's what we're most interested in. And you can see there's a lot of different ways that I can look at the results of what I just entered in for all those inputs. Cash flow analysis, the property operating data, some different financial indicators, resale analysis, loan analysis, investment return analysis, which is my favorite, some summary of the leases, a summary for each tenant. So a lot of different possibilities. So we'll start here looking at the cash flow analysis. So here's our income based on the assumptions that we put in for the base rent and for our lease renewals. Okay, so we have income 1,398,500 in year one, 1,412 in year two, and so forth. Remember, I said the vacancy didn't kick in until year four, so we had zero vacancy, then vacancy starting in year four. Then we have our operating expenses. So this is the total of each of those that we had talked about for the operating expenses. That gives us our net operating income. Okay, our income minus the vacancy minus operating expenses gives our net operating income, NOI. Subtracting out our lease payment, I'm sorry, loan payment, subtracting the loan payment, and then gives us our cash flow before tax. And then based on that, we have a cash on cash return. That's dividing the cash flow by the equity that we have in the property. So we're getting a 7.7% cash on cash before taking into consideration any price appreciation. And then some calculations for tax purposes. We have our net operating income minus depreciation, because we can, for tax purposes, depreciate the property. I think we had 39 years as the depreciable life on this, since it's an office property. It's 27.5%, 27.5 years for residential, 39 years for non-residential property. Our loan interest, not the total loan payment, but just the loan interest, is tax deductible. So subtracting out our depreciation and our interest from our net operating income gives us taxable income, or if there were a loss, it would have a negative there. And that it would be used then to calculate our taxes based on the tax rate that we had input. think that was 35%, so 35% of the taxable income. Notice the taxable income, 299,028, differs from the amount of cash flow on the property, okay, because the taxable income depends on the amount of depreciation and interest deductions that we have. So we pay taxes on that taxable income. We've got cash flow then left over of 172,427, which results in a cash on cash on an after-tax basis of 4.79%. So those calculations are done every year for 20 years. You may not be looking at it over 20 years, but it's automatically done for all 20 years. I'm going to kind of focus in on a 5-year holding period when I look at some of these other measures. 10 years is a pretty typical holding period for a discounted cash flow analysis. Let me jump down to the investment return calculations, because I think those are, at least for me, those are sort of the bottom line of all this. So again, we have those calculations for each year. We've got our cash flow that we've already talked about, but then our cash flow that we have from sale of the property, this is actually done every year as if we sold the property that year. So if we sold the property in year 1, we would have 3,494,150. If we sold it in year 2, we'd have 3,737,993, etc. Of course, you can't actually sell it every year. The idea is just if we could now look at it as if we had a 1-year holding period, 2-year holding period, 3-year holding period, and so forth. There is a tab I can show you that has the actual calculation of this resale price every year, but let me just go ahead and show you some of the resulting return measures here that I think are, again, kind of the bottom line of the analysis. And I'd say one of the key ones is your internal rate of return. What rate of return am I getting on this property after taxes, but taking into consideration the financial leverage? And so if I'm going to have a 5-year holding period, my internal rate of return would be 12.88%. You can see how that varies. If you sold it after year 1, because of haven't really held it long enough to take advantage of getting some of those lease renewals, and especially if you had any selling costs involved, that's really hurting your rate of return, but goes up quite a bit when we go to year 2 and then to year 3, and then we kind of get up to the 12% range. Interesting, it kind of drops down a little bit in year 7, but then it goes back up. Again, we have a lot of things going on here with the way the leases are renewing and what the rates are when those leases renew. So on a 5-year holding period, if we kind of focus in on that, if we held this property for 5 years and sold it after taxes and considering the financial leverage, we're going to get a 12.88% rate of return. The modified rate of return is the one that takes into consideration that we may not be able to reinvest the cash flows at that higher 12% rate, or in this case, the 12.88% IRR. We can't reinvest money at that same rate. So we're going to reinvest the cash flows each year. I think we had a 5% rate. It didn't really impact the return that much, but because we're reinvesting cash flows at a lower rate, it pulls our return down a little bit. So the modified IRR, as it's called, sometimes called an adjusted rate of return, that's 12.32%. NPV of cash flow and reversion is the present value of the after-tax and levered cash flows. So let me go back to the general input just to remind you of the different discount rates. Okay, remember we have an 8% discount rate we're going to use for unlevered cash flows, but a 12% discount rate for the levered after-tax cash flow. So the 8 is the overall unlevered, 12 is the levered after-tax cash flows. Okay, so we go back to our projections and the investment returns. This NPV of the cash flows and reversion is using that 12% rate. And you can see for year 5, that would be 800, 285. What that means is if what I want is a 12% rate of return, I would be willing to put in $800,285 into this property to get exactly a 12% rate of return. That would be 800, 285 in equity that I would put into the property. Now that's more than the amount that I actually have to put in, but that's because my actual return here is 12.32%. So I'm getting a higher return than the rate of return that I'd put in of 12. It's important when you select those discount rates in that general tab to be thinking about what holding period you have in mind, because you can see the rate of return does vary with the holding period. One of the important ones here is this last one, PV of NOI plus reverting. Okay, that's actually the estimated value of the property. The focus of MarketEdge, RealNext, has always been more from the investor's perspective and what kind of returns the investor would get, and the present value of the cash flows. But there's other programs that have more of an emphasis on the appraised value or market value of the property, and that would be highlighted even on the main screen. It would say, for a 10-year holding period, the value of this property is $13,355,719, which of course would be rounded. But what I want to emphasize is, for the 12% discount rate that we had put in as an overall discount rate, if that's the typical rate of return that investors want in the market, that an appraiser would use in an appraisal, the appraised value, the market value of the property, would be $13,355,000 or $13,356,000. That would be what the appraiser would put in the appraisal report, at least what the appraiser would put in under the income approach if they were using a discounted cash flow analysis. This could also be a broker's opinion of value. So what you're saying is you think, based on your analysis, that the appropriate value of this property is $13,356,000. That could also be an investment value. This may not be a typical investor. This may be some specific investor that you're doing an analysis for, and so you're putting in assumptions that you think reflect what that investor would want for a rate of return, and what that investor thinks the projected cash flows are going to be. And so we would call this an investment value for the property. But what I want to emphasize is we can estimate the value of the property based on our assumptions. If our assumptions are typical of investors in the market, this would be a market value for the property. Let me kind of pause there, Jeff, and see if you or Bobby have any questions. If the audience doesn't, I know I've covered a lot, and we can go back and make some changes in the inputs and look at some of the other
Handful of
output.
questions, Jeff. Why did you pick 12%? What would be an investor's rationale for picking that equity discount rate? What is sort of the premium to risk-free or other that would want you to you peg it?
Right. Yeah, that's that's the most difficult one, right? Because we can't really observe what rate of return. It's not like a bond where we can say, well, look, this is what investors are wanting on bonds. And so there's really a lot of different approaches that are talked about in courses like in CCIM courses and Appraisal Institute courses to try to come up with that. One way is surveys. You've got the PwC, used to be Peter Corpat's survey, and now Real Estate Research Corporation, and many organizations do surveys of investors, and so they simply ask investors, what rate of return do you want in the current market? And so surveys is one approach. Another approach is to start with cap rates that we can observe, the cap rate being the current net operating income to value for properties that are selling in the market. And the rate of return that investors want is that cap rate plus an expected growth in income and value of the property. And so what you would do is you take the cap rate and you would add on to the cap rate what you think property values are going to grow at, whether it's 2% per year, 3% per year. So that would be another approach. And then a third approach is to know what investors typically want as a premium over bond rates. I find that cap rates really track BAA bonds pretty closely. If you look at the rate for BAA bonds, those are pretty similar, or at least they track pretty closely what's happening to cap rates. But again, you'd have to add a risk premium onto that. That question is really relevant, I think, right now, because with everything that's been going on with the coronavirus, and the fact that transactions have really almost halted, everybody's scrambling to figure out, how am I going to value properties for this quarter? I work with an organization, as many of you know, called the National Council of Real Estate Investment Fiduciaries, which is your large institutional investors that have to put a value on the property every quarter to report to investors. And the appraisers right now are working on what that's going to be for the third quarter. By the time the appraisals are all done and the data gets in, that comes out on like the 25th of this month for the first quarter. And I've been involved in a number of different conversations with the appraisers, and they're all kind of scrambling right now to figure out how we're going to put a value on the property. And one approach you can always take is what we've just been through today, which is what they typically do, is a discounted cash flow analysis. And the question is, well, how have discount rates changed over the last month? They've surely gone up. Investors are going to want a higher return. There's going to be more of a risk premium, but we don't really know what that's going to be. So there's a lot of uncertainty right now in what kind of discount rate to use. We can look historically at what's happened in recessions, and we know that cap rates tend to go up pretty quickly, and so there's a lot of guesswork and recognition that there's going to be uncertainty in the values that are going to be used in this type of discounted cash flow analysis, certainly for this quarter and maybe for several quarters to come.
The next question was about TI. Do we calculate it on a per square foot or in a total amount when you were putting that?
Yeah, we could do it either way. I think I typically see it on a per square foot basis, and a lot of times it's pretty comparable to what the current rent is per square foot. If the rent is $14 a square foot, you might see TIs of $14, but that's of course a concession that we also often see, where if the market starts to weaken, instead of lowering the base rent, tenant might ask for higher TIs.
Yeah, as well as free, free rent option as well that you didn't go into, but that in too much detail. But that's another option per lease.
Exactly.
Next.
Yeah, go ahead.
No, can you model different types of leases in the building? So if you have office up, the upper floor is retail on the ground, if there are different, whether net or gross or other stops, depending on the part of the building.
Sure. Yeah, we had to indicate when we set this up that it was office, but the leases really, I think, work pretty much the same way for retail or industrial. we don't currently have the ability to put in a projection of the sales for a tenant. So you would have to kind of calculate that on the side if you had overage rent. But aside from that, um, I don't see why you couldn't do mixed use and mix some retail and some office in the same analysis.
Is there a way to adjust the property tax for the sale and purchase price?
I'm not sure I understand that one, but the tax rate you put in is fixed and stays the same every year. Maybe what's being suggested is we allow for a different tax rate each year depending on what year you're selling the property.
Yeah, I'm not sure either. Maybe it might be on the buy side, on the sell side. So maybe they're asking, are you paying you have a fee going in and a fee going out? And we do have that fee. There was a variable for your cost of acquisition and your cost of sale. So you could factor that in if there were. That's not really just a tax, but if there are some luxury taxes or other property stamp tax or other that might need to be adjusted, so it's less
Right.
of an income tax.
But I think we usually think in all the programs that I've seen, we usually kind of think what's your marginal tax rate, and we don't usually assume it's going to be different each year depending on when you sell the property.
I'm not sure this is just a particular on this instance, and I'm not. We have to go back. Based on his initial framework, the building shouldn't actually show cash flow from each tenant until year 3. So you had vacancies. Did you fill those vacancies in year 1? When you originally modeled it, those spaces showed as vacant, and yet your vacancy factor in the analysis doesn't come up until year 3. What was going on there?
Was it showing some vacancy? I didn't think it showed any
I think
vacancy. Let me
we,
go to
we had when
cash flow
you go to
analysis.
your initial, you have 0 vacancy, but if you go to your income tab, the income tab above, you
Right, we
had
don't.
base rents at 0, 0, for tenant
Oh,
2,
those
3.
those are just completely ignored. Those tenants. These are just tenants inputs that I'm not using.
So
They have zero base rent. Yeah, those aren't even impacting the analysis since there's no square feet. There's no square feet for these ones that I'm not using. It's
So the
probably
building
confusing. It's
is
probably confusing that I don't have
96,000
them.
square feet. You've allocated 96,000 square feet. So that is the space. So that was a little bit of confusion. Sorry about that, Jim. It just showed that this building could have had 6 tenants. It's been filled up with 3 tenants instead of 6.
Right. Yeah. Sorry, I should have the, the three, just 1, 2, 3 here, and then the rest of them blank.
If commissions are entered, are they paid up front the same month? Can they be paid over time? Can they be paid 50% on execution and on occupancy? What's the ability to flex the commission
Yeah, I
expense?
think those are all paid right away. I'd have to go back and check, but I don't think there's a way to change that. I think those just come out as soon as the lease is signed.
If you go into more, does it give you an option?
And that's what I just clicked on. I didn't see. Um, that's just additional information you could put in.
Inside the spreadsheet itself, you're able to edit fields?
We could export this into a spreadsheet and you could change it, but let's keep notes on some of these things, Jeff, because
Yeah,
we are going to be
you can
um,
you can make
we're
edits.
just
So
starting like we did with the discount rates. We're starting to try to enhance the program to meet what our users want, because that's what we're trying to do. Um, so having the commissions be payable over the lease term, would that be I guess an option, right? Upfront
yep.
over the lease term.
or multiple payments. Often it's paid on signing and occupancy. How would you address retail leases with different CAM and reimbursement terms?
Yeah, again, this is an office, but we could have set this up as a retail property, and we had different options, remember, for each of the leases for the reimbursements. So we should be able to handle any way the reimbursements work for a retail tenant. And we could also take into consideration whether that includes reimbursement for the common area maintenance charges.
How does the
What I'll work on maybe for future webinars is some other examples of some other property types.
Yeah, that'd be good
Yeah.
to maybe throw retail. Does the where does the equity discount rate apply, and how does it
Okay.
show up in the
Yeah.
analysis?
So let me go to the projections and the investment return analysis. The equity discount rate is used for this one right here, NPV of cash flow and reversion. So cash flow is the after-tax cash flow, and it's the cash flows after leverage. So it shows up in this present value calculation right here. And the difference between that and this one, the PV of NOI and reversion, this is using the overall unlevered discount rate. Before, the program used to use the same discount rate for both of these, and I yelled and screamed and made that change, that where we have the 3 different discount rates now, because clearly they shouldn't be the same rate. Does that
A
answer the
while back,
question? Yeah.
we did the development analysis for ground up development, but would you use development analysis if it's just a rehab or a major rehab of an existing facility, or how would you otherwise
No,
model?
I would just put in the CapEx. We have the option here to put in the capital expenditures, and exactly when those capital expenditures are incurred. So I would just put that in as additional capital expenditures, which you can have depreciated as soon as they start to, as soon as you spend the money on them.
Uh, just an aside, they're saying that this is similar to Argus. Is Argus in the background? No, it's not unrelated to Argus. Jeff, in his textbook, has done models using Argus and using MarketEdge. We get the same answer a lot faster with a lot less pain and a lot less training. But Jeff, Argus has some additional features for portfolio level and waterfall or other that
Right.
this.
Yeah, this is kind of like a light version of Argus. I liked it for the textbook because it's cloud-based, which Argus wasn't for a long time. I'm not sure it's yet completely cloud-based. Whereas, as we've been doing here, I'm just using a web browser to use the program. And I used to have Argus in the textbook, and I replaced it with MarketEdge, and it gives the exact same answer as Argus. Argus does have additional things that go beyond certainly MarketEdge, like the portfolio analysis, which we may add at some point, but this was really designed actually by a CCIM to mimic what's done in CCIM courses, and I think captures most of what I would think most of our users would be doing on a day-to-day basis.
Yeah, certainly private investment buy sell analysis is completely handled here. Is there a way to import T12 P&L from owner's Excel?
Yeah, I was showing you on the income tab, we can import our rent roll. So you would, as long as you had the same labels here, it would pull it right in. So you would just have a spreadsheet that would have a column labeled, the tenant, the square feet, the base rent, and so forth, and it would pull the information right in.
You can actually export and import. So you can export a
Right.
template and then use that template for your import, Michael. And then,
Exactly. Exactly. I didn't look at the
and by
projections.
the way,
Yeah.
if you have all of your data in CRM or Marketplace, you can import it from there as well. So particularly from the CRM, if you've modeled and you're tracking a stacking plan of a building, all of that information can come straight through into MarketEdge.
Right. This is the resale analysis. We just went right to the bottom line before of the cash flow that you would get from sale and in our return analysis, but you notice it does calculate for each year. What if I sold it that year? What my resale expenses would be, paying off the loan, calculating the taxes associated with the sale, using our capital gains tax rate, and considering that there's recapture of any depreciation that you've taken. So all that is reflected in these calculations. And remember that we get this resale price by taking that cap rate and applying it to the net operating income in the year after the sale of the property. Personally, I think you should have a specific holding period in mind, though, because the discount, or I mean the cap rate that you enter, um, wouldn't necessarily be the same if you were going to hold it for 5 years versus 10 years. Um, so even though we calculate it every year as Argus and other programs do, I think it's best to have a specific holding period in mind when you do this type of analysis. 10 years being pretty typical.
There's a question on BOVs. I think it's next Tuesday. Dave Monroe is going to do a session on BOV. When we do the BOV with MarketEdge, we do not only this financial analysis with all of the assumptions to give you a range, but also bring in comps for sale or lease to help substantiate, and then to have a descriptive analysis and what your assumptions were and what the price range could be, should be, and a recommended valuation point. So we're not going to go into BOV today, but this is part of uh, the work done to create the BOV output in MarketEdge, and we'll be going through that in the next session, in one of,
Right.
not Thursday session, but next Tuesday.
And let me emphasize again that the row that would be relevant for that would be this PV of NOI and reversion. That's figuring out
Yep.
what you would pay for the property in order to get the return that you put in. But you'd want to also look at comparable sales and so forth as part of that analysis. If you don't have comparable sales, though, you almost have to rely on something like this. Okay, well,
But it's one
hard,
more, I think,
yeah. I was gonna
and
say
we're
hard,
just
hard,
at the
hard to
top of
believe
the
it's
hour.
almost, yeah.
Um, in this example, why wouldn't the PV be 11,595,436? So that's your first number. So in year one, that's the value, but you were showing that based on a 10-year holding period, you had a different value.
Right. So each of these years, it's what the value would be if that's the year that you sold the property. Um, so again, I'd say 99 out of 100 appraisers use a 10-year holding period in their discounted cash flow analysis.
So the
So
present value based on a 10-year hold is that number.
exactly.
That's not the value of it in year 10. That's the present value of it
It's the
based on the
value
10.
of it today if you sold it
Exactly.
after
Yeah.
10 years, right? So each of these would be the value today, but based on how long you held it. I'm not, again, wild about showing it every year because obviously you could only sell it once, and all our inputs really should be based on having a holding period in mind, especially your terminal cap rate. Um,
Perfect. 1 hour, we're through all the questions, just on time. Jeff, great job. Thanks, everybody. We really appreciate your interest. Hope you all are doing well and continue to take advantage of this window of time to sharpen the saw, improve your business, and to get ready for new deals to come. more questions, send them in. Ideas for future sessions, please send them in. We do have another session on Thursday. We have we also have a user group coming up. We have a couple of other special sessions coming up. One with Blaine Strickland on his new book, Adapt, next week. And then Cray coming up the end of the month with all of the new enhancements to the platform. So a few more weeks of Brunch with Bobby for sure, as long as we're in lockdown here through the end of the month. If it continues and the interest continues, which it has been strong, we'll keep this rolling, and love your ideas on what we can do, what session topics you'd like to hear about, and we'll do our best to keep you well informed. Thanks again, and let's see.
Everybody stay
Yeah,
healthy.
thanks everyone. Just to
Yeah,
make
there's
sure
a question.
that
Where do you send suggestions? Send them to me. It's easy. I can funnel them and make sure they're covered. jfin@realnext.com, and I'll make sure they get in the queue. Thanks, everybody. Thanks, Jeff. Thanks, Bobby. Have a great day.
You're welcome.
Take care.